Exploring financial routes for business growth and stability frequently converges on a crucial point: the role of business loans. This financial instrument is not merely a resource, it's a catalyst for growth and innovation, and the bridge to achieving your business dreams. But what exactly constitutes a business loan and how can it serve your business needs? Let's demystify the concept and explore how you can leverage this tool to propel your business forward. The meaning of a business loan revolves around it being a specially designed financial product for entrepreneurs to infuse external funds into their operations. Unlike equity financing, which requires giving up a share of your business, a business loan is a debt that you repay over time, retaining full ownership of your company. This business loan definition underscores the importance of business loans in maintaining operational flow and pursuing expansion without diluting ownership. A business loan is a loan specifically intended for business purposes. As with all loans, it involves the creation of a debt, which will be repaid with added interest. There are a number of different types of business loans, including bank loans, mezzanine financing, asset-based financing, invoice financing, microloans, business cash advances and cash flow loans. Types. A bank loan may be obtained from a bank and may be either secured or unsecured. For secured loans, banks will require collateral, which may be lost if repayments are not made. The bank will probably wish to see the business's accounts, balance sheet, and business plan, as well as studying the principal's credit histories. Many smaller businesses are now, however, turning towards alternative finance providers, especially in the case of smaller firms. Loans from credit unions may be referred to as bank loans as well. Business loans from credit unions receive the second highest level of satisfaction from borrowers after loans from small banks. Methods of business loan assessment, monitoring, risk management, and pricing affect the growth and performance of banks and other lenders. They also affect access to finance by would-be borrowers. The types of business financial information on which lenders base their decisions have changed significantly over the years, along with the management of business lending in general. SBA loans. The U.S. Small Business Administration, SBA, does not make loans, instead it guarantees loans made by individual lenders. The main SBA loan programs are SBA 7A, which includes both a standard and express option, microloans, up to $50,000, 504 loans which provide financing for fixed assets such as real estate or equipment, and disaster loans. In FY 2016, total 7A volume was $11,967,861,900 and total 504 loan volume was $2,517,433,000. Mezzanine finance effectively secures a company's debt on its equity, allowing the lender to claim part ownership of the business if the loan is not paid back on time and in full. This allows the business to borrow without putting up other collateral, but risks diluting the principal's equity share in case of default. Once considered the finance option of last resort, asset-based lending has become a popular choice for small businesses lacking the credit rating or track record to qualify for other forms of finance. In simple terms, it involves borrowing against one of the company's assets, with the lender focusing on the quality of the collateral rather than the credit rating and prospects of the company. A business may borrow against several different types of asset, including premises, plant, stock, or receivables. Invoice finance. In recent years, it has become increasingly difficult for small and medium-sized enterprises to obtain traditional finance from banks. Alternative options are invoice discounting or factoring, whereby the company borrows against its outstanding invoices, with the ability to obtain funds as soon as new invoices are created. It is often questioned which option is best for your business, factoring or discounting, and the answer depends on how the business wants to be perceived by customers. With factoring, the finance company charges interest on the loan until the invoice is paid, as well as fees, and the finance company takes ownership of the debtor ledger and uses its own credit control team to secure payment. With invoice discounting, the business maintains control of its own ledger and chases debts itself. Microloans. Smaller loans, usually for loan amounts of $100,000 USD or less, are referred to as microloans. Banks are less likely to make these loans than alternative lenders. When they do, the decision is usually based on the personal credit score of the business and/or the business credit score. Online lenders / non-traditional lenders. There has been a rise in the number of online lenders offering small business loans. Online alternative lenders originated an estimated $12 billion in small business loans in 2014, with unsecured consumer loans representing $7 billion and small business loans accounting for approximately $5 billion. Non-bank lenders that make small business loans have doubled their outstanding portfolio balance every year since 2000. Some online originate loans from their own capital. Others may use a marketplace model, in which they match borrowers to loan products from a variety of lenders. Popular business loan products that online lenders offer include term loans, lines of credit, and merchant cash advance. Others use crowdfunding platforms that allow businesses to raise capital from a wide variety of sources. This model has grown and will keep growing due to the fast process and minimum documentation it requires. Business loans may be either secured or unsecured. With a secured loan, the borrower pledges an asset, such as plant, equipment, stock, or vehicles, against the debt. If the debt is not repaid, the lender may claim the secured asset. Unsecured loans do not have collateral, though the lender will have a general claim on the borrower's assets if repayment is not made. Should the borrower become bankrupt, unsecured creditors will usually realize a smaller proportion of their claims than secured creditors. As a consequence, secured loans will generally attract a lower rate of interest. Lenders that make business loans often use a UCC filing to alert other creditors of their security interest in the property of the business. UCC filings may be placed against specific assets, or a blanket UCC filing secures interest in all property. UCC filings may affect the business credit score and may make it more difficult to obtain subsequent financing. UCC filings have become less common in alternative financing. Most lenders will only file a UCC against the business in the event of default. Personal guarantees. Many lenders require principals with 20% or greater ownership in the business to provide a personal guarantee. The personal guarantee allows the lender to attempt to collect the debt from the personal assets of the guarantors. Small business lenders may waive the personal guarantee requirement if the business has strong business credit scores and revenue. In May 2016, changes to the Member Business Lending Rule by the National Credit Union Administration Board further improved these loans, by allowing credit unions discretion in obtaining a personal guarantee from a borrower. Risk in business is one of the common thing, but it is said that the more risk you would bear, the more profit you would earn. You have to be secure in order to make your lives better and easier. You have to earn a lot of reputations and things that could bring your minds better and easier in the same manner. There are thousands of people who don't want to lose or stop their business just because of financial downs in their business. The most important thing for them is the financial problem at that moment. You have to find a source where you could find financial support, but sometimes, businesses have bad credit among the market because of down market and their banks forbade them to provide loans. What to do then? Don't worry more, because there are some financial institutions that provide business startup financing Texas to the business, so you can easily bring the best idea in your business and make it upward. Loans are always a helping hand for business. Sometimes, you create a budget for bad times, but you may require some kind of loan for the business and also a great variation of your financial position. Loans from banks are only possible when you have a good credit. Taking loans from banks also include a lot of formalities that you have to be far from. The most important thing in this respect is the time. You need a fast and easy business loans that is only possible if you go to some financial institutions that provide loan at a cheaper rate of interest, and that is always better for the person having a bad credit in the market. How to proceed for these loans? The process that you have to adapt in these loans is nothing but only to give an application for the loan describing the purpose of the loan. This is pretty easy for anyone that you can also take these loans if you are currently working as a businessman and want these loans for your business. The limit of the loan can be nearly to $1 million, so you are going to get something huge. You need to give them an application that you can give as the application regarding to the loan. This may include some of the personal information along with the information related to the business you are requiring the loan. They ask you just for an identity proof that you can give them in any form. This can be anything related to the driving license or the voter ID, so they could be verified for the loans. They are providing faster loans, so you could utilize the loans as short as possible without having trouble. These loans are bringing a lot of businesses on track and helping them with financial terms when they require the most. Advantages of a business loan. Quick dispersal. The swift access to funds ensures that neither business operations nor growth initiatives face unnecessary delays. This rapid financing option keeps your business agile, ready to seize opportunities as they arise. Minimal documentation. The streamlined application process reduces complexity and accelerates the approval timeline. This ease of access cuts through bureaucratic red tape, making it simpler for businesses to promptly get the support they need. Competitive interest rates. Businesses can manage their capital more efficiently with favorable borrowing costs. These competitive rates ensure that loans are a viable option for financial growth without imposing heavy financial burdens. Flexible tenures. Customizable repayment periods are tailored to align with your business's financial rhythm, significantly improving cash flow management. This flexibility allows businesses to plan their finances more effectively, ensuring they can meet their repayment obligations without strain. Business loans transcend mere financial aid, serving as engines for advancement and enduring success. They are vital for managing immediate expenses or supporting ambitious expansion goals. Understanding the role and process of business loans is the first step towards unlocking your business's potential. With the right strategy and planning, achieving success is attainable. Axis Bank offers a range of business loans tailored to meet the unique needs of various industries, with customizable repayment periods, competitive interest rates, and a streamlined application process. You can avail of these loans easily through the bank's mobile and internet banking modes. Let Axis Bank be a part of your business success story. Thank you for watching this video.